Welcome to CFTC Talks. I'm your host, Andy Bush. Please remember, there's an important disclaimer at the end of the program you should listen to. Well, it's been a busy week as the agency jointly held a conference with Kansas State University's Center for Risk Management, Education, and Research. We had over about 300 people attend and had a great time covering a wide range of topics from macroeconomic trends and issues impacting the agricultural futures markets to the importance of these markets for managing risk and protecting participants from fraud, manipulation, and other illegal activities. And there were 4 really big panel discussions that had researchers present their papers. And today on the show, we'll be bringing you one of those folks to discuss his research as well as the state of the U.S. agricultural markets. So our guest is Scott Irwin, and he is the University of Illinois Lawrence J. Norton Chair on Agricultural Marketing at the Department of Agricultural and Consumer Economics. Dr. Irwin, welcome to CFTC Talks.
Glad to be with you today.
Awesome. Well, ladies and gentlemen, to say Dr. Irwin is an expert in this field is like saying the Chicago Cubs had this slight little drought between their last World Series win, because I think Dr. Irwin is one of the best known in this space. And he's really known for his work on the impact of speculation in commodity markets. And Dr. Irwin, you've published numerous academic articles on this subject, and you've actually testified before the U.S. Congress, the OECD, and the CFTC, as well as publishing op-ed articles in the New York Times and Washington Times. But let's go back to the beginning of you getting into this research. I have to ask you, what drew you to speculation?
Well, I've always been fascinated with the commodity markets from a young age. And if you're interested in the market performance and public policy debates that surround commodity futures markets, inevitably one of the issues that gets a lot of attention and that keeps reappearing year after year after year is this question of the role of speculators. Basically, are they good? Are they bad? Indifferent? Keeps coming up, and I like to work on issues that have relevance and can be applied out there in the practical real world. So it was an issue that attracted my interest.
So was there any specific thing, did you grow up on a farm where somebody lost money and they accused speculators of this? Or, I was just wondering, if you don't have it,
sure,
that's fine.
Great. No. Really, I would say what I developed very young was a fascination with the markets. I grew up on a farm out in Iowa that was corn, soybeans, and hogs, and a little bit of cattle.
Okay.
And my father had been, previous to farming, an elevator manager, so he engaged in some hedging and futures trading activities. And so from a very young age, I was exposed to it, just fascinated. There was always talk about the prices in Chicago when I was a kid. And that just fascinated me. I'm so old that I used to trail my dad to the grain elevator in my hometown of Bagley, Iowa, where we would check the prices from Chicago on an old-fashioned paper ticker that would come across on rolls of yellow paper. And that was exposure for the commodity markets, and I was hooked, and I studied it as an undergraduate and graduate school and never really stopped.
Oh, that's amazing. Well, it's great to have your dad kind of show you what he was doing and thinking about and experiencing. So that's wonderful. But let's get a few of the basics out of the way for our audience, because since you've studied this for so long, maybe sometimes it's fun to go back and talk about the difference between traders and speculators.
Mm-hmm. Well, there's a lot of different traders, and they have different functions. For example, most traders traditionally in commodity futures markets were using older language. We called them scalpers. These were floor traders, scalpers. And that's, if you wanted to count bodies of the people that were trading, that would probably have been the number one group outside of small retail speculators that were involved in the markets. So you had your scalpers, and then you had outside public speculators. You had a few really large floor traders that engaged, I would say large, traded at a large scale in terms of speculation, but the vast majority of floor traders and those closely associated with the markets didn't take long-term positions. But of course, there were the spectacular, well-known firms and individuals that would take large bets in the markets, and those are, I think, what most people mean by speculators, at least in the traditional sense.
I see. Well, with this in mind, your research has spanned a long period of time, and you've seen speculation in the agriculture markets change and evolve, and I'm guessing these changes have probably sped up over the last 5 years. So what are the top 3 changes you've seen, and really what's driving these changes?
Well, the top change is easy, and that's the change to an electronic order processing system for the markets from the old human open outcry, hand signal and voice trading system. I'll call that the old pit trading system versus the electronic. That's by far and away the largest change. I believe that's the largest structural change in these markets in the last 150 years. And so we're just beginning to kind of scratch the surface of everything that change means.
And what are, did you have 2 others? I guess that's such a big one that everything else just kind of pales, right?
Right. Well, there certainly are. There certainly are. I think the other 2 I would rate as the change in the kind of directional speculator. In particular, that's the rise of the hedge fund and managed money traders.
Right.
That's been going on for longer than the last 5 years, but that's a big change in my professional career, and one that doesn't get talked about a lot, but is also, closely related to the move to electronic markets. But it was already happening before we moved to electronic markets. Was the increased speed and availability of information due to the rise of the web, the data resources that people have, and just increasing access to information and trading. Sometimes I'm really fascinated by how easy it is to now open up an account and get online and make a few clicks and you can trade. In the old days, you had to, literally drive someplace, fill out an application, and talk to somebody, and then wait for your check to clear. And now it's a matter of hours, and you can be trading. So it's just remarkable change in just that overall environment of the market and how fast it moves and how quickly you can do things online.
Well, and you can just be sitting in your tractor on your iPhone and putting orders in, right? I mean, assuming you can connect to the trading system. But yeah, that has really been, for us as well, obviously, and all of finance is just, that has been a great way within the agriculture sector for sure, but broadly speaking, that it covers everybody in this space. And I guess from looking at what you do, how does this affect or change the nature of doing research on speculation?
Well, it's
Is it made it? I guess the question I have is: it easier or harder now to do this, right? Because there's reams of data now, right?
Right. It's easier to get access to data, but it's there's so much more to deal with. We have a major push here in the research group I'm a part of here at the University of Illinois to be studying these issues associated with the change to electronic trading. And you're talking about now studying these markets at the millisecond level. And the amount of data that you have to deal with is just amazing. We're talking about terabytes and terabytes of data on just price quotations and bids and offers and things like that. So I guess you could say the electronics is kind of a blessing and a curse all at the same time.
Yeah, you have to have have the computer systems and the storage facilities, right? Now, good thing there's cloud computing, but wow, that makes it a lot more challenging, I can imagine. Before we get to your paper, let's spend a little bit of time talking about FarmDoc and FarmDoc Daily. Ladies and gentlemen, the purpose of FarmDoc is to provide crop and livestock producers in the U.S. Corn Belt with around-the-clock access to economic information and analysis to better manage their farm businesses. And you started this back in 1999, and you're coming up on your 20th anniversary for the site. And of course, FarmDoc Daily produces daily research on what's happening in the agriculture space. But I guess what I think is amazing is the sophistication of the information and resources available on the site, from finances to prices and weather. So going back again to the origin of this, what were the challenges of getting both of these things up and running?
Well, that could take a long time to tell that story, but I'll make it really short. When we started FarmDoc back in the late 1990s, the web was relatively new, and we wanted to try to figure out how to harness it for our commercial agriculture extension programs that we conduct out of this department. And we came up with the then revolutionary idea of, well, hey, we have all these different people doing different things, related to extension and what I'll roughly call Corn Belt farm economics. And, this was the revolutionary idea. Why don't we put all that in the same website? That seems...
That's crazy. What are you thinking?
Yeah, but at the time, now it seems like, well, was there ever a world that it wasn't like that, right, Andy?
Right, for sure.
But at the time, that was considered revolutionary, I guess only because we did it first.
Right.
And that was hugely successful because it was just our first experience with, people loved the idea that for free we could just go to one website, type in FarmDoc, we'd eventually get there, and we could find budgets and basically whatever we were doing, we had committed to putting first on that website. And it took off from there.
That's fantastic. It is really funny. You think back to those times when, and email was a big thing, just kind of new back then too, in the mid '90s, of course. But that was fantastic. I guess my question after that is like, looking at this now, what's your favorite part of this? I mean, I could guess, but I have a feeling I know what the answer is. But what's your favorite part of like where this thing is headed right now?
Well, right. I mean, my baby is really FarmDoc Daily, which was a truly crazy idea that we came up with now 7 years ago. And, the world, we'd done FarmDoc, got it on the web, but things were changing. This was the mobile revolution had really taken off. The blog revolution had really taken off. Everything had really gone 24/7. And so we were trying to figure out how to respond. So we came up with this crazy idea of, well, if this is the world we live in, we're going to publish one article of original analysis related to Corn Belt farm economics every day.
Wow. Every day. That is awesome. That's a lot of work to get out every day. It's a lot to organize every day.
Yes, we call it feeding the beast. And
yeah.
But it has really changed my career. It's what I just love writing in that format. I kind of call it humorously for my own work and what I do, I call it first draft economics. We're not saying that we're getting, every detail right. We want to be, 90-95% correct, but you got to have it up there, and it's an amazing platform for being able to have an impact on any kind of issue you could imagine. Anything from what might planting delays do to the crop this year to, RFS policies to budgets, everything you see up there. And so, we're, I think, approaching 2,000 articles up there now.
Wow.
So it's really been an amazing platform. And then on top of that, probably what I enjoy the most, which is related to my FarmDoc daily work, is Twitter. I have really taken to Twitter, and I really enjoy engaging with people directly in that sphere as well. So I'm really fortunate. I can honestly say that, I've been out now working, we'll just leave it at well over 30 years, and I'm enjoying and I'm as excited about my job today as I ever have been.
Oh, that's fantastic. Well, I think what's so wonderful about it, too, Scott, is the fact that you bring that level of expertise, and you, to some extent, as they say, journalism is the first draft of history. You somewhat democratize it. You democratize that knowledge and information out into really kind of fungible things for people to munch on, so that they can understand the world as it's happening every day, instead of just publishing, a paper a quarter or however often you did it, which are wonderful papers. I don't want to dismiss that, but I think from the practical standpoint, that sounds where like it's really resonating with people in the farm space, what you're doing now.
Oh, yes. It's just amazing. I would say, our engagement of our ideas and our research and our writing, has just gone off the charts because of that. It's really certainly interesting to do. Give you an idea, I'd have to check the exact figures, but we are right now, I think about 2.2 or 2.3 million visits a year to FarmDoc Daily.
Oh my gosh, that's wonderful. That is wonderful. Well, I'm sure there's a lot of interest on FarmDoc Daily on this subject, because I have to shift over to the elephant in the room, and that's low agriculture prices. Overall prices fell in 2014. They really haven't recovered much, Scott, as you know. I spoke with USDA Secretary Sonny Perdue last week, and he said they are working really hard on raising demand for U.S. ag prices internationally. I think he's got Ted McKinney running to every country out there saying how great our products are. But the supply issue, that appears to be challenging. So what do you see are the major issues for why prices are so low?
Well, we've had a combination of factors. Number one, there was, coming off of the really high price years, an expansion of acreage around the world. Put incentives out there, farmers around the world are going to expand the acreage. And so that's happened. Then secondly, we had the kind of the exact same time that was going on, we're starting to go through a period of lower than average worldwide economic growth, which, reduced demand and reduced prices over and above the rates of growth that we had been seeing.
Okay.
So that was number two. And the third one, and the one that I really focus on a lot as I think the underappreciated factor, is since 2014 in particular, the U.S. and the world, but particularly the U.S., has been through an extraordinary run of good weather luck. And this has had a major impact on boosting production, yield, and played a significant role in the surpluses that have held major crop prices down, corn, soybeans, and wheat.
So what you're saying is we need a good drought someplace, not here in the United States, but maybe outside.
Yeah, well, it's always you want the drought to occur some other places. I always tell people my grandmother really understood economics growing up on the farm, because she always told me, growing up in Iowa, she always told me to pray for a drought in Illinois.
Well
Every
said.
farmer in the world will understand that. And,
well said. I would have liked to have met your grandmother. She sounds like a lot of fun.
She was amazing. But anyway, so that's I'm not been in what I would call I call it the Uber bear camp for the last year or two. I'm not wildly bullish on crop prices, but I have thought that we were at very low levels and these factors were going to begin to grind and turn around, and that we would see some better prices in the future. And we're already seeing that happening to some degree right now.
All right, fair enough. All right, well, let's finally get to your paper for the conference. I'm sorry we waited so long for this, but the name of the paper is Trilogy for Troubleshooting Convergent Manipulation, Structural Imbalance, and Storage Rates. As you put in the paper, the bedrock underlying commodity futures markets is the convergence of futures and spot, or the cash market prices during the delivery period. Scott, why is that? Why is that the bedrock? Why is that so critical?
Well, because the cash market is considered the benchmark, or, commercial reality. And to have confidence in the integrity and representativeness of futures prices, you have to have confidence that the futures price is based on a pricing dynamic that is ultimately going to come together with the commercial reality in the cash market. And everything else depends on having confidence in that relationship holding.
Interesting. Well, if prices don't converge, I guess then it calls into question whether or not you can use the futures markets to hedge your underlying exposure in the cash market, right? And yet this is exactly what happened between 2005 and 2010. So as your paper dives into this, but what were the causes and what did you discover in your research?
Well, a research that I've been engaged in over the last decade now ended up honing in on kind of an obscure part of the specification of our grain futures contracts.
Okay.
And that's something called the storage rate. So if someone takes delivery we'll just use CBOT wheat as an example. Number one, you don't actually immediately get physical wheat. The system has evolved for good reasons that the delivery instrument is something really close to wheat that represents wheat. In the old days, it was something called a warehouse receipt, and now we generally use something called a shipping certificate that represents wheat in store. And since there's actual physical grain backing these delivery instruments, then if you take delivery and get one of these delivery instruments for CBOT wheat, someone is holding grain to back that certificate, which means that you have to pay a storage fee while you hold the delivery certificate if you choose to hold it instead of loading out the grain.
Okay, I get it.
And so that's been a part of the grain futures contracts from the beginning, as far as I know, the history of these contracts. And it's a provision that doesn't attract much attention outside of the industry. But what happened starting in 2005, really specifically March 2005 in corn, was that the rate that the market wanted to reward storage went above the fixed rate that's specified in these futures contracts.
Huh.
And that seemingly small little thing can explode into a really large problem under certain circumstances. And so that is, the evidence is now very clear that that's what happened. It's, for example, why the CBOT went to a variable storage rate rule. And we now know that once you get those storage rates adjusted up enough so that they're above typically where the market wants to value storage, then everything goes back to working fine, the markets converge, and we'll never hear about storage rates again.
In your paper, you talk about that this is the variable state storage rate is somewhat controversial. Why is that so contentious?
Well, this is exactly the kind of contract feature that really informed large commercial interests always battle about in terms of setting up the terms of a contract. And in this case, this was a major change of something, a constant fixed storage rate that everybody knew, and that's the way the grain futures markets had always worked. So it's a big change. But there's actually, I think, an understandable reason for at least part of the controversy, and it gets into this. That fixed storage rate that I talked about, in the trade, it's how you define what's called 100% of full carry. So that when traders are trying to figure out, how to price contracts 1 year from now, they have this fixed benchmark of how much it costs to store. Mm-hmm. And that's out there. Everybody can see it, and everybody's got the same benchmark. And then everybody prices off of that. And that's the way people have trained and learned how to use these markets. Under the VSR system, you don't know definitely what that fixed carry benchmark, that 100% can be. In other words, the 100% can move up and down.
Right.
And a lot of traders don't like that. They claim that means that there'll be less open interest in the deferred contracts because people don't have as firm a grasp of the relationship of the prices across contracts. And there's some evidence that might actually be the case. So I think that's the big disagreement right there.
That's really interesting. So it's the uncertainty or lack of ability to forecast that out with perfect certainty, I guess I should say. My guess is there's quite a bit of trading on VSR, right? I mean, the underlying in the cash markets, that would be my guess, right? That there's a lot of playing around with that, I guess is the best way of saying it. Does that make sense?
Yes, absolutely. It's one more thing that the traders have to try to project. And then on top of that, VSR is also controversial because it was instituted at a time of extraordinary tumult in the markets and in the market value of storage. And there is an enduring puzzle and riddle in the wheat markets, which is why is it taken under a VSR regime such extraordinarily high storage rates on these wheat futures contracts to get them to converge? At its peak in 2011, the VSR peaked at 20 cents a month. Now, it's been a while back, but right. At 20 cents a month, that's $2.40 a year of potential carry, which, that's enough to almost pay for new storage in a year, which is unheard of. So there's, a lot of that's a big issue that you'll hear from people in the trade. I think they mistakenly argue that VSR caused those high storage rates rather than reflected the market realities, which is my view. But I also have to admit that I don't think we have a very good handle on what were those market realities that caused those VSR storage rates to go so high in wheat, and they don't look as high recently, but they've bumped up to 11, 14 cents in the last year or so. And by historical standards, those are really high storage rates again. So that's a puzzle we've got to get a better handle on.
Well, it sounds like you have plenty of material to keep doing research and daily doc on, right? FarmDoc on. That's great. Well, let me just, in the last few minutes that we have here, let me just switch gears a little bit and ask you one more question before I let you go. What are your top three risks for the ag markets in 2018?
Well, excellent question. Number one is easy, and it's trade. And the risks of an escalating trade war that, in particular, with China.
Right.
Ag has a huge stake in that not happening. Half of our soybean exports go to China. I mean, we have in ag lots of vulnerability, but it's not just soybeans. Pork just got slapped with a 25% tariff from China in retaliation for our steel and aluminum tariffs that we put on them.
Right.
And so that's number one. Probably the second biggest risk is another exceptional summer of growing season weather here in the Midwest that would continue to, and particularly in soybeans, that would be really problematic. And then the third one, and this is one that I think probably doesn't get quite enough attention, is continued ratcheting up of interest rates from the Federal Reserve Bank. This could, in particular, have major implications for land markets. So those are my top three.
All right. Well, those are really good ones. I love the, good weather is bad news kind of angle to this, but it totally makes sense. All right. University of Illinois Professor Scott Irwin, thank you so much for coming on the show. This is great today.
It was really enjoyable, and I would look forward to continuing the conversation in the future sometime.
Fantastic. We'll do that. All right, that's our show for this week. If you want to listen to more podcasts, you can go to our website, cftc.gov, and click on podcasts, or you can go to your podcast button on your phone and type in CFTC Talks and click on subscribe to get them every week. We'll be back next week with another guest on our quest to learn about the markets we watch. I'm Andy Bush. Thanks for listening. This has been CFTC Talks. But wait, we're not done yet. It's time for a disclaimer. The CFTC is providing this information as a public service, and it is neither a legal interpretation nor a statement of CFTC policy. Reference to any specific product, service, trademark, manufacturer, or service provider does not constitute an endorsement or recommendation by the CFTC. The CFTC is not liable to any consumer or any third party for any direct, indirect, incidental, consequential, special, or exemplary damages or lost profit related to the use of the information provided or referenced in this podcast. Selection of guests on the podcast does not imply an endorsement of any particular individual or entity. Many individuals and entities provide similar services to those of the guests. The views and opinions expressed by the guests in the podcast are their own and not specifically endorsed by the CFTC. Moreover, the information provided in this podcast should not be construed as investment advice. Consumers should rely on their own inquiries as to accuracy and relevance of the information incorporated or referenced in this podcast and assume the entire risk related to its use. The CFTC is providing its interpretation of market trends solely to inform the public of a framework for projecting possible outcomes under different scenarios. If you have any questions concerning the meaning or application of a particular law or rule administered by the CFTC, please consult an attorney.